Welcome to The Explainer. Today, we're connecting the dots on what was a really mixed-up day in the markets. On the surface, it looks kind of confusing, but once you start to pull on a few threads, a really fascinating picture starts to come together.
So if you just looked at the numbers, you'd be scratching your head, right? The Dow, which is full of those big traditional companies, it actually ended the day up. But the S&P 500, the broader market, was down. And the tech-heavy NASDAQ, it got hit pretty hard, down more than 1.5%. So what's the real story here?
Well, what if I told you that these numbers aren't telling a bunch of separate stories? What if the big sell-off in software, a weird forecast from a chip maker, the rising price of oil, and even the corporate battle over weight loss drugs are all part of the exact same story?
And that story, it starts right here. It starts with the massive, all-consuming race for dominance in artificial intelligence. And this isn't just some tech story anymore. It's a huge economic force that's kicking off a chain reaction across the entire market.
Okay, let's dig in. So you have Alphabet, Google's parent company, and they absolutely crushed their earnings report. But the stock still dropped. Why? Because they also announced they're going to spend a staggering $175 billion this year. That's almost double what they spent last year, and pretty much all of it is being shoveled into the great AI arms race.
And here we go. This is the first domino to fall. Hedge funds are making a massive bet against traditional software companies. We're talking $24 billion in profits so far this year. Their whole argument is pretty simple. The same AI tools that Google is spending billions to build are about to make a whole lot of existing software totally obsolete.
And you can literally see this great divide playing out in real time. Money is just pouring into the companies that are building the AI infrastructure. Look at Google Cloud. Its revenue jumped 47%. At the exact same time, money is running away from the broader software sector. The main software ETF, it's down more than 20% already this year.
And this is where the ripple effect gets really unexpected. All that money being spent on AI data centers is creating a worldwide shortage of high-end memory chips. So Qualcomm, a giant in the mobile chip world, just had to lower its forecast. Not because people don't want new phones, but because there literally aren't enough memory chips to go around to build them. The AI race is now directly messing with the phone in your pocket.
But these huge tech shifts, they don't just happen in a vacuum. They connect right back to the immense pressure that's building on the average person's finances.
Just think about this for a second. A few years back, almost everyone had a mortgage rate under 5%. Today, a surprising 1 in 5 homeowners has a rate over 6%. That higher cost of just keeping a roof over your head eats into everything else, limiting financial freedom for millions of families. And it's not just housing either. Student debt is still this massive anchor. A new report just showed that even for workers over 50 years old, the ones still paying off student loans have retirement balances a full 30% lower than their peers who don't have that debt. It's just a constant drag on building any kind of long-term security.
And this financial pressure, it shows up in some really surprising places, like healthcare. Right now, we're seeing this fierce, epic battle in the multi-billion-dollar market for weight loss drugs. Eli Lilly is just surging ahead, while its main rival, Novo Nordisk, is actually bracing for a sales decline. And this huge corporate fight, it has direct consequences for all of us, for consumers who are facing sky-high costs for these drugs that are, well, they're life-changing, but they're also incredibly expensive.
Okay, so you have this backdrop of tech chaos and consumer pressure. Now, let's layer on top of all of that the oldest market movers in the book: good old-fashioned fear and geopolitics. Because today, global uncertainty was a huge part of the action. I mean, you couldn't ask for a clear picture of a risk-off day, a day when investors just run for safety. On one side, you have Bitcoin, a classic speculative risky asset. It plunged over 5%. And on the other, you have crude oil, which is basically a barometer for geopolitical tension, and it jumped over 3%. You can just see the money moving from risky bets to tangible stuff. So why did oil spike? Well, there was no mystery at all. It happened right after former President Trump issued this really sharp warning to Iran's supreme leader. When a major political figure starts talking tough about the Middle East, you can bet the oil markets are listening, and prices react like instantly. So finally, let's zoom all the way in, because behind all of these macro trends and algorithms and geopolitical chess moves, at the end of the day, the market is still driven by people. It's driven by their ambition, their strategies, and how they define success.
Check this out, this story from Amazon. CEO Andy Jassy just picked a new shadow advisor.
This is this incredibly sought-after job where an executive basically becomes the CEO's shadow, going to every meeting, learning every single part of the business. It's a fascinating look at pure ambition and the calculated moves people make to get to the absolute top.
But then, on the complete flip side, you have this really powerful contrast. NFL Hall of Famer Terrell Owens was talking about the Hall of Fame recently and basically questioned the value of the whole thing. He's suggesting that the ultimate prize in his profession, the legacy that people chase their entire lives, might be losing its meaning. A story of ambition met with a deep question about what legacy is even worth. And that kind of leaves us with this final question, doesn't it? On a day when AI algorithms are fundamentally revaluing entire industries, when geopolitical fear can shift billions of dollars in a heartbeat, and when individual ambition clashes with the very idea of legacy, it really makes you stop and ask, what is the true measure of value today? Is it the market cap of a company? Is it your influence? Or is it maybe something else entirely?